Can Wall Street be trusted with Bitcoin custody? The rise of Bitcoin ETFs has introduced new risks that many investors haven't considered. In this clip from the TFTC podcast, Jessy Gilger, lead advisor at Sound Advisory and former traditional finance veteran, breaks down the hidden dangers of Wall Street's attempt to integrate Bitcoin. In today's discussion, we'll examine 3 central points: how ETFs function as Wall Street's version of Layer 2, why concentrated custody poses systemic risks, and how these financial products are reshaping market dynamics. Before we continue, if you enjoy these breakdowns, hit the like and subscribe button for more TFTC content. Full episode linked below. The final segment reveals a crucial shift in market structure that could impact Bitcoin's next bull run. But first, let's understand why comparing ETFs to Layer 2 solutions matters for Bitcoin's future.
Ticker symbol MSIG ETF, right? Mm-hmm. I would really like that, where you've got multiple entities securing an ETF's coins. That would be a better version of an ETF, but ETFs are still Wall Street's Layer 2. Yeah. Right. They got into the game and they came in like right at Layer 2. And I know it's a rough analogy, but that's kind of how they're operating. Is you could transfer ETF shares from brokerage account to brokerage account, and all that basis information would actually come with it too. Not an on-chain footprint, but it kind of gets the job done of transferring value in a Layer 2 kind of Wall Street sense. So they're gaining popularity. There's far more Bitcoin in ETFs than there are in the Lightning Network.
When Jessy talks about ETFs being Wall Street's Layer 2, he's explaining a fundamental shift in how traditional finance is adapting Bitcoin to their existing infrastructure rather than embracing Bitcoin's revolutionary design. Think of it like this. Instead of actually moving Bitcoin on the blockchain, these ETFs are just moving paper promises of Bitcoin between brokerage accounts. It's similar to how the Lightning Network allows for faster Bitcoin transactions off the main chain, but in this case, Wall Street has created their own version that fits their traditional systems. The key difference is that with Lightning, you can always claim your actual Bitcoin, but with ETFs, you're trusting Wall Street to handle the real Bitcoin while you trade their version of it. This is a significant departure from Bitcoin's core principle of not your keys, not your coins. What's particularly concerning is that ETF Bitcoin holdings have already surpassed the amount of Bitcoin in the Lightning Network, showing just how quickly Wall Street has managed to accumulate Bitcoin through this new system. We've clearly established how ETFs function as Wall Street's Layer 2, but this is just the beginning of the potential issues. As we'll see in our next segment, this concentration of Bitcoin creates significant vulnerabilities that could affect the entire market.
So protect yourselves. Maybe sell Bitcoin, which is heresy, I know, but I've seen it and recommended it to people because I think they'll be safer and probably have more Bitcoin for themselves, their spouse, or their kids by not having to sell if we dip again in a year or 2 or 3.
So your bold prediction is we're gonna have a massive rug that creates
that's the risk. And so part of being the financial planner is like, let's identify as many pits as we can and try not to fall into them. And so I see ETFs as a 6102 away, a matter of national security, whatever administration decides, agnostic to that side of things. But hey, we need Bitcoin. Let's go ahead and these ETF, they'll print the money, make ETF holders whole, quote unquote. But I see that as a huge honeypot. Coinbase specifically running the majority of those ETF funds.
What Jessy is highlighting here is a crucial vulnerability in the current ETF system that builds directly on our previous point about Wall Street's Layer 2. Coinbase, a company that has historically shown mixed commitment to Bitcoin's core principles, is now responsible for holding a massive amount of Bitcoin for these ETFs. This creates what we call a honeypot, a single point of failure that becomes an increasingly attractive target as more Bitcoin accumulates there. When we think about Bitcoin's fundamental value proposition of being a decentralized monetary network, having such large concentrations of Bitcoin under one company's control goes against these principles. The comparison to regulatory seizure is particularly relevant because we've seen similar situations in traditional finance where government intervention has led to asset freezes or forced liquidations. Sup freaks, this rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin easy to use and hard to lose. It's the easiest 0 to 1 step, your first step to self-custody. If you have friends and family on the exchanges who haven't moved it off, tell them to pick up a BitKey. Go to bitkey.world, use the key TFTC20 at checkout for 20% off your order. That's bitkey.world, code TFTC20. At 10:31, We've always emphasized the importance of proper Bitcoin custody, and this situation with ETFs exemplifies why that matters so much. The fact that a Bitcoin-focused financial advisor is recommending some clients to reduce their Bitcoin exposure because of these systemic risks shows just how serious this concern is. We've now seen how ETFs create a layer 2 system and the risks of concentrated custody, but there's an even bigger shift happening in market dynamics. In our final segment, we'll explore how these ETFs are fundamentally changing the way money moves through the crypto ecosystem and why this could have major implications for Bitcoin's future market cycles. Next up, we'll examine how the introduction of ETFs is completely reshaping traditional crypto market dynamics, potentially changing how future bull markets might unfold.
But now with the ETFs, which are taking an insane amount of inflows, like that's basically like a one-stop. It's not like you get into the BlackRock ETF and then you diversify into Solana or whatever. Like that flow of capital into the broader crypto space is way different now. And most of the flows are coming into the ETFs, and there's no possible way that they're going to flow into crypto. So that's one thing I question heading into this next cycle is like, will it be as pronounced as in the past? Because the dynamics of the pure flows of money into this market are different.
What I am explaining here is a fundamental transformation in how money enters and moves through the cryptocurrency markets, and it's directly connected to the layer 2 structure and custody risks we discussed earlier. Historically, when people wanted to invest in cryptocurrencies, they would typically buy Bitcoin first and then use that Bitcoin to trade into other cryptocurrencies. This created a natural flow where Bitcoin served as the gateway to the broader crypto market, but the introduction of Bitcoin ETFs has completely disrupted this traditional pattern. Now, when institutional investors or traditional retail investors want Bitcoin exposure, they can buy it directly through their existing brokerage accounts via ETFs. This money never touches the broader crypto ecosystem. It stays within the traditional financial system's plumbing, which ties back to how these ETFs function as Wall Street's layer 2. This structural change has significant implications for both Bitcoin and the broader crypto market. In previous market cycles, Bitcoin's price increases would lead to what we call alt season, periods where people would take their Bitcoin profits and speculate on smaller cryptocurrencies, creating a ripple effect throughout the market. But with ETF investors, there's no mechanism for this to happen. You can't take your BlackRock Bitcoin ETF shares and trade them for other cryptocurrencies. The concentration of Bitcoin in these ETF structures, particularly with Coinbase as a major custodian, as we discussed earlier, means that a significant portion of Bitcoin's market activity is now happening in a completely separate layer of the financial system. This could lead to a more mature, focused Bitcoin market that's less connected to the speculation in other cryptocurrencies. It's like Bitcoin is graduating from being the gateway to crypto speculation and moving into a new role as a legitimate financial asset within traditional portfolios. However, this maturity comes at the cost of the direct ownership and permissionless nature that made Bitcoin revolutionary in the first place. The ETF structure, while making Bitcoin more accessible to traditional investors, creates a layer of separation between investors and the actual Bitcoin network. Instead of participating in the Bitcoin network directly, these investors are participating in Wall Street's version of Bitcoin, further reinforcing how ETFs truly are functioning as Wall Street's layer 2 solution for Bitcoin, with all the risks and changes to market dynamics that come with it. Have you experienced similar concerns about Bitcoin ETFs? Let me know in the comments. I read every single one. And if you found these ETF insights concerning, you'll want to watch our analysis of Bitcoin's growing institutional risks and market volatility. Click the video on your screen now. Don't forget to like and subscribe for more daily content. Thanks for watching. Stay humble, stack sats,